Broadcast. Welcome to the Zaner MarketCast, episode number 41. 41 episodes of your one and only spot to keep up with all of the agricultural market news. I'm Joe Nikruto.
And I'm Dan
here
Hussey,
with
everybody.
Dan Hussey. Today is Friday. It is the middle of January. It's
17th.
Freezing cold.
It is.
It sucks. It's going to get colder next week, but maybe just temporarily. We'll see what happens. Something is going on this next week. Some sort of game, sports contest.
Just a little bit of a national championship.
Yeah, I don't follow either one of these teams too well, so I'm not sure what's going on, but might be of interest to you.
Our best wishes came true. We got a little bit of an office rivalry with our own Adam Packard, a OSU graduate, myself from Notre Dame. So we got both of us here in the national championship for going into Monday night. It'll be fun. And of course, let's not forget, in celebration of MLK Day.
MLK Day on Monday. Markets closed. Closed today. Closed on Monday. Do not reopen. No Sunday night open.
Are you sure?
I'm pretty sure. Fact check me, please, as always. But I think that there's no Sunday night. Markets do not reopen. Ag markets do not reopen until Monday evening. But again, double check me. Monday evening at 7 o'clock is what I'm going with. Mm-hmm. Dan, so you have a lot of money on, you say it was Miami of Ohio? That was Ohio State. Right? Miami?
Yeah, no, my father told me never bet on Notre Dame football, certainly to never cover the spread. So, I mean, I think that's a wise investment choice for anyone out there.
That is so funny.
But still.
Who's favored?
I believe it's Ohio State by about 8 points right now. So we'll see. That's been tightening up. It started off at 9, it looked like, and I bet it'll be under a touchdown by game time.
And the game is in
Atlanta.
Atlanta?
Looks like, yeah.
Okay.
So I had a lot of friends before the Orange Bowl booking places in Atlanta just as a cheap call option on maybe getting down there. But we'll see, right? So
we should do an educational piece on booking cheap call options.
Right?
It
might be like something else you can do these days.
Cheap Airbnb. Before we get started, Dan, we want to let everybody know that if you're interested in hearing about grain market movement and strategies daily, you can sign up for our Ag Hedge hotline hosted by expert market strategist Ted Seifert, totally free, and gives you the chance to connect with us personally if you have any specific questions about the markets or agricultural commodities in general. We will be happy to speak with you about that. If you're interested in learning more about how this price action works and how to make price action work for you, it's a perfect way to take that first step. And link is in the description below. Sign up for that. Totally free, zero commitment. Not the smoothest intro I've ever done, Dan, but
got the job done.
Intro nonetheless. So what should we do? Should we talk about prices? It's certainly been a heck of a week in terms of price here. Volatility reigns supreme. Or should we jump right into these news stories? What do we do today?
Well, let's go into price, I guess, right away. And I guess give a little bit of a notion here that we had a news break this morning that we're not covering. President Xi of China and soon to be President Trump had a little bit of a phone call this morning in the pre-market hours, which put a bid under our row crops. I think
about 7:20 or so, right before the break, right?
Right. I mean, you look at right before the 20 minutes before that biscuit pause, somebody somewhere caught wind of that phone call, apparently going well based off of what we saw in market price action. But that's the only news we really have to report, as there hasn't been any fine details on what they discussed. If trade agreements were, verbally made and what have you. But I think the way the markets reacted is that we're going to be seeing a less turbulent trade policy and trade detailing with China than we had with Trump 1.0.
And so for the corn market, you had weekly open 469 3/4 in the March contract. High was 485, low 469 1/4, close 484 1/4. Change on the week up 13 3/4. Another big week here in corn. Funds are long, an estimated 312,000 contracts. RSI on my screen was 70.47. All of your daily moving averages, I believe, are below us. 487, your next actual kind of structural resistance, where that was a previous high from, I believe, June 13th. And so what can we say about that?
Yeah, I mean, a great recovery, going a little parabolic here in old crop corn. You got to talk about price rationing of demand now with the way we've moved. How the commitment to traders has shifted from a net, negative 300,000 to now net positive 300,000 in the commitments. We'll see another number out today from the CFTC to see where that's at. But you're starting to see that spaghetti, span out below us. The moving averages are all aligning. The faster ones are, are now moving above the rest of them. And, 18-day moved above the 200-day. We'd expect the 55-day to now move above that 200-day here soon. Looks pretty good. You got to look at this chart, though, coming into $5, and I see a bit of a cup formation, and I wonder if we're not going to get a bit of a handle or some sideways chop and sideways price action before moving for that push to 5. But that's all just looking at a typical cup formation or that rounding bottom we have.
You say too early to rally cap this? I mean, are we?
I think we're in the midst of the rally, right? You're due for a pullback with the idea that we just made a new high for the month, high for the week, high for the day. When corn does that, there's typically a little bit of profit taking involved.
For sure. So what we've got here is a rather large fund position. You've had rather significant movement in one direction for quite some time. What I wonder is if you don't get the precipitation in South America that we think we're going to get, and if we don't get the potential jawboning from the new administration right after the inauguration, how high is too high? I can't seem to look at that chart and say this is where it should stop. Can you?
No. At this point, I mean, we're talking corn here, right?
Corn,
that $5 mark is the major psychological level above us. Again, like you pointed out, that 487 area into 490 seems to be some kind of ideological level that we held on to back in July and fell from. We're back into that old area of resistance from last summer. It's certainly a key place in the chart. And maybe I would turn our attentions to new crop corn, which has been running into a bit of a resistance, about a 30-cent range that we've been stuck in, and that 200-day moving average that we still have been unable to overtake here could be something to watch for if it does, for the continuation of the whole corn complex.
Sure.
But it's interesting to see, and we were talking about it before, how this has quickly become a very big spread market.
Yeah. And maybe my contention is that maybe that weakness further out is more a function of the spread or unwinding short March long D spreads. And now they're having to unwind that or build a spread in a different direction. And that is what is weighing on the December. Obviously, December corn, new crop situation, both American and safrinha corn crop come online from there. And maybe it's too early to get super, super excited about that piece. But I think it's also might not be a good idea to try to derive some sort of further out signal from the way that the December is currently trading, because it may be subject to the spread. How about beans? We opened the week 10.24 3/4. High was 10.64, low 10.18.5 in March beans. Last trade I saw was 10.34, not above 10.40, which would maybe have been ideal. But certainly you could understand some reticence where we sit today with what is coming up this weekend. That was up 8 3/4 on the week. Funds are long. First time I think we've said this. Funds are long, an estimated 3,000 bean contracts. Held the 10 and the 100 bar moving average this morning. Barely got underneath that, I believe, but got right back above it. 18-day comes in or is all the way down back at 10.08. Wouldn't surprise me to see a test or an attempt at that 10.08.
No. There's an upward sloping trend line there, 55-day as well. The market traded an inside day of price action with a very large range right now. So volatility is the key word here in the soybean market.
For sure.
1077, that 200-day above that 1080 area, that then the precursor to $11 to the upside is, of course, a logical target. If we see more consolidation, we see that support hold, and the market wants to turn higher, right? But I would not be surprised to see the market still take a dive down to that, close to that $10 mark to test it. And honestly, for a healthy rally or for a longer term run higher in beans, it would make sense to be able to, go back, test old resistance, now support.
So yesterday in corn, the ICG cut this bean corn crop to the number that everybody's thinking in their mind, which is like a 1.2 something, right? But there's none of that going to happen in beans. This bean number globally is not coming down, and may in fact be going up.
So.
And
right.
so it's hard to look at corn and beans and say that you have apples to apples. It's just not the same thing.
Right. And to play a little devil's advocate here too, corn seems to be price rationing demand. In other words, rallying here in the face of smaller supplies from the U.S. a lot more than soybeans are. And I say that because we didn't push through the highs of the week of the month here today. on the back of what should have been very bullish trade news. And I kind of am starting to play a little devil's advocate here and looking at that Brazilian real, how weak that market is, which advocates for more exports out of Brazil, but also could mean that the U.S. looks to Brazilians' larger crop to meet some of our domestic demand by importing some beans off the Atlantic seaboard. So keep an eye out on those bean shipments into the U.S., into Georgia and South America, or into southern ports, as that could be a way of alleviating some of the price pressure here.
And to that end, March meal opened the week 298.50, high was 309.50, low 293.50. Last trade I saw was 297.20, and that was down 110. Not the same price action in meal that we're seeing in the rest of the markets. Meal market could still be carrying a 47,000 contract short in meal. And oil, same story. Open the week 46.01, high was 47.10, low 44.85. Last trade 45.69, down just 11 on the week, fractional decline, but they're still short 33,000 contracts. And so with this news that's coming down the pipe, and the idea that beans are really kind of carving into recent territory that we have not been in a while, right? Meal and oil had a big week last week. Don't get me wrong.
It's still hanging in there.
It had a big week last week. But yeah. And so I'm just saying with this meal, you're not really, we're not launching this. I don't know. Maybe I'm drawing too much. Maybe the products are not giving me quite the signal that I want. But I don't really feel as warm and fuzzy.
We don't have the finer details, I feel like, that make the trade confident, right, in the demand that'll be there in the future. Plus, there's still a lot of talk that SAF and other things are still years out. Is that going to affect the 24, 25 crop? Probably not more than just short-term speculation.
For sure. Wheat.
Doldrums, huh?
Another nothing week. Minor, trying to carve out some sort of bottom yet again. Opened the week 5.30 1/4. High was 5.44 3/4, low 5.26. Last trade 5.30 3/4, up 1.5 on the week. 82,000 contracts short in wheat. If they do get some sort of fire going there, or if they do get some sort of spark, there's plenty of fuel. But and I thought I saw somebody, I'm not sure who the analyst was, and if she's watching, I'm sorry. She's probably not watching. But if you are watching, I'm sorry for forgetting. She mentioned that wheat kind of, and a lot of folks in the ag community may be looking at wheat as a value play, right? In reference to these other markets, wheat is beginning to look attractive. And so,
and I was going to say that until today, you had that corn to wheat rate or wheat to corn ratio starting to widen back out again. But boy, corn just went up and wheat is not still. So amazing. Like, you got to wonder yourself, are we going to parity in these products? And
some of this money, it probably goes without saying that some of this money coming into the space here is investment money, right? Not just your typical funds, but also general investment money looking for a home, looking for maybe some sort of inflation hedge, as there has, this week saw your headline inflation number, your core inflation number sort of continue to moderate. But there are things that are still rather expensive. There are still some spots where inflation is rather sticky, and maybe being long some wheat, maybe being long some corn and beans is a play for folks that are moving money around, right?
Absolutely.
I don't know.
And to that point, wheat headlines, if we remember back to 2020 through the 2022 period, were war driven. Now we're getting peace driven headlines. Gaza and Israel looking like they may be signing some peace deals. The war in Ukraine, a lot of speculation it'll wind down with Trump in office. So wheat is, if wheat was a wartime play, well, there's a reason it's, there's heavy shoulders.
It's going to be some sort of some sort of peace.
And certainly, if you, as you mentioned, inflation is being curbed, all these things. So
allegedly,
we'll see. There's still, I agree with you though. I think there's a value play there. And again, pay attention to those spread markets, and certainly get in contact with us if you want to talk more about how the spreads since harvest have been really where the activity's been, more so than the outright contracts.
Other side of the value coin, Feb live cattle opened the week 198.75, high 198.85, low 195.72.5, closed at 196.75, down 2 on the week. But man, cattle has been on a tear.
On an absolute tear, above all the moving averages in both the feeders and the fats. Coming in on those contract highs or making them, depending on what contract you look at. And we're talking about all-time highs now too, and we're a little bit of a pullback, I think, in the short term wasn't out of the question just based off of where price has been. But at least futures price, right? The cash markets have still been on fire. We've seen bids up in the 205 to 210 range for those fats. I mean, when your fats are still at a 10 cent, the cash is at a 10 cent premium to the board. I mean, there's a lot of boards selling there from a hedging perspective getting done. I understand that, which can keep it depressed, but there's still room to run to the upside if this wants to go.
Seems that way. Fed cattle not showing much interest in being below the 10-day moving average. Normally, we'd say comfortably above the 18, hallmark of a bull market, but this one doesn't even want to retrace. So we're going to open the border for Mexican cattle again, or Mexican feeders. It's just that you would think that there's an opportunity there for them to take some off here, and they're just not doing it. Same thing with the feeders. Open the week 269.70, high 270, 17.5, low was 265.65. Last trade, I'm sorry, that's the last trade. Last trade was 268.05. That's down $1.35, right? So minor pullback here in the cattle complex after what has been just a stellar couple weeks. Some producers getting rather nervous. These prices, I think, give a lot of folks vertigo, and they wonder how long we can maintain these price levels.
And I think that's a fair assessment, right? We've been up here, and all the more reason to have a discussion about ways of managing your risk and producer risk in these markets.
For sure.
I mean, we all know that the last time we were up at these prices, we didn't last. And I know a lot of guys I talked to regretted not doing something when we were, 50 cents lower.
Yeah, for sure. That sort of covers the weekly numbers. It was a pretty good week so far. We've got some uncertainty. New administration arrives on Monday. Maybe it rains, maybe it doesn't rain. We'll have new price action on Tuesday, right?
Mm-hmm.
How about NOPA
news cycle?
December U.S. soy crush soars to record 206.604 million bushels. Carl Plume, our buddy from Reuters, NOPA members, which account for at least 95% of U.S. processed beans, crushed 206.604 million bushels of the oilseed last month, up 6.9% from the 185 million bushels crushed in November, and up 5.8% from the December 2023 crush of 195.328 million bushels. Big numbers here, Dan. Last month's crush was above the average estimate of 205.498 million. In a Reuters poll of 8 analysts, estimates range from 202 million to 209.5 million, with a median of 205.5 million bushels. December crush also eclipsed the previous record monthly crush of 199.943 million in October. U.S. soy processing capacity has swelled over recent years as crushers built new plants and expanded existing ones to supply biofuel makers with vegetable oil feedstock. NOPA members crushed 2.215 billion bushels in 2024, up 4.4%, from the prior year. These are big numbers, and speaks to just what Carl says here, is that you have an increase in capacity. We are finding a home for this stuff. Anecdotally, you talk to people that work in these processing plants, and allegedly this meal and oil is flying off the shelves.
I mean, and that's where I think that price rationing of demand in the soybean complex comes into play, right? If we got tightening balance sheets in the U.S., old crop is needing to get bought up here. Processors need it. We've got more processors online. And that's where I also make the case, though, that the U.S. will probably see some imports of soybeans from South America at the big crop prices we've seen now, or big crop we've seen down there with lower real. It only makes sense to curb some of that with some imports at this point. But USDA also published some interim rules on technical guidelines for climate smart agricultural crops used as biofuel feedstocks. Press release from the USDA. The interim rule established guidelines for quantifying and reporting verifying the greenhouse gas GHG emissions associated with the production of biofuel feedstocks, commodity crops grown in the United States. These guidelines will facilitate the recognition of climate smart agriculture within the clean transportation fuel programs, creating new market opportunities for biofuel feedstock producers while enhancing climate benefits. The rule issued today establishes a framework to connect climate smart agricultural practices applied in the production of feedstock crops with the reductions here I lose my place in the story, with reductions in carbon footprint of biofuels. The rule includes 3 feedstock crops: corn, soy, and sorghum. Here I am. It also covers CSA practices that could reduce CHG emissions or GHG emissions, or sequester carbon, including reduced till and no-till cover cropping and nutrient management practices, such as the use of nitrification inhibitors. Now, I want to point out that we have already discussed how those practices could precurse over 50% of Midwest farmers out of these programs. So we still don't have the rulings and the clarification that we would like to see to bring everybody under these types of programs. Importantly, the interim rule allows for the adoption of CSA practices both individually or in combination. Through this interim rule, USDA is establishing standards that can be used to quantify, track, and report the impacts of these practices. The interim rule establishes voluntary guidelines that may inform the development or requirements for other programs which incentivize low carbon biofuels. So they're hoping this will be a blueprint and model for future programs. The interim rule includes guidelines for the following: biofuel feedstock crops and entities in the biofuel supply chain, quantification of farm-level crop-specific carbon intensity, chain of custody standards for entities in the biofuel supply chain, including traceability and record-keeping standards, auditing and verification requirements, and the climate-smart agricultural practice standards for the biofuel feedstock crops included under the rule. The USDA is requesting public comment on the interim rule to help inform future revisions or additions to the final rule, and that is where everybody can get involved at www.regulations.gov and let them know that you may not be included in this program under their current forms.
Importantly, the word combination. So you can adopt these CSA practices as an individual producer, or you can adopt the practices as an individual producer in combination with your processor.
Yes.
So that's the key. Last week we talked about it. The week before that we talked about they were only giving these credits to processors, right? Or they were going to rule out certain processors. I know ethanol was concerned. So this may alleviate that concern. Of course, we don't know everything about this. There's more to read and more to understand about this, but that would be key, because if they could, if you had your individual participants working together to gather those credits, that's really where it's at for the agricultural sector.
Yeah. So thanks for listening to the Zaner MarketCast today. If you need more just because you just can't get enough of us, you can follow us on Facebook at Zaner Ag Hedge or on Twitter at LinkedIn in the Zaner Group. If you have any questions you want answered on the show, fill out that form and the link provided below, and we'll answer it right here on air. Thanks again. Be sure to like, comment, and follow the podcast and not miss a beat, and we'll be back with you as price action develops. Take care, everyone.
Have a great weekend.